Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
What kind of cash flow is being produced? What kind of risk is there for her? What kind of income does she need? Because again, we're going to solve for that first, right? Solve for the income needs first, and then let the portfolio be designed relative to the cash flow and the risk.
Here is a true retirement income plan that shows you this is how much money you will be able to spend of every month, of every year for the rest of your life, right?
Yeah.
So few of those plans out there.
Yeah, it's just, unfortunately, it's a little bit kind of a laziness. I mean, I don't know how else to just, being honest, that's just, the reality is it takes work to do that, and a lot of firms are not willing to do that work. What we want to do is create cash flow streams so we can maintain the integrity of our portfolio and not only have more income, but more assets and hopefully more money to pass on to our kids. It's really about the confidence. I always say, helping give people permission to spend their own money. And so we have to have the confidence in that cash flow, knowing that can be produced so they can have the lifestyle they have. People don't realize, what happens is we custody with Schwab, right? So we work with. So every month, our clients are getting a check that goes directly from their Schwab account to their bank account, just like their paycheck, ACH right in there. So it's kind of neat. It's no different than when they were working. Get a paycheck, goes directly deposited into their account, just like when they work now in retirement. That's what we're going to do, is create that same paycheck for them.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
We have 30 minutes of great information just for you.
Don't go anywhere. The show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions in to us from all over San Diego, and we answer them right here on the show. David, I've got some great questions this week, and my first one is from Melvin in Carlsbad, and he writes, I'm thinking about buying an annuity for income now that I am retired. I want income guaranteed for as long as I live, and I don't want to get gouged with high fees. I have heard a lot of bad things about annuities, especially from Ken Fisher. What's the difference between buying a variable annuity and a fixed indexed annuity?
Well, Melvin, thank you for the question, and that's a great question. And annuities can be a good cornerstone. We've used them as a firm for over 20 years, so they can be but we use everything: real estate, dividend-paying stocks, annuities, so kind of the kitchen sink, kind of Swiss Army knife type of planning. But the fact is that there's a massive difference between a variable annuity and a fixed annuity. So if you see fixed, it means you have principal protection. Variable means you're going to have two things: higher fees and more risk. So I would lean towards a fixed index annuity with an income rider. It's going to be less expensive and typically better for the client. So those can be kind of a landmine when you deal in the annuity side of the business. It's difficult. So I'm glad that he's at least doing some research on that to find the right answer.
Yeah, and I think that for better or for worse, there's some people, they love annuities, they hate annuities, right, and everything in between. But is it a fair statement to say, David, that the annuity that has really gotten the negative press is the variable annuity, and kind of maybe more so than the rest, as someone should look at that with a red flag or yellow flag?
Yeah, we're agnostic. We're fiduciaries to our clients, so we just use it as a tool. So sometimes it's appropriate, sometimes it's not. What I can tell you for sure is that the variable annuity is going to have more fees than a fixed index annuity.
Gotcha.
So the bottom line is that we're going to go to that first if that's what the client needs. Again, It's a piece of the puzzle.
Tool in the toolbox.
Absolutely.
Next question from Henry in Delmar, and he writes, David, my dad died about 5 years ago, and my mom has just continued working with the same advisor. As far as I know, he takes good care of her, but in the last year we've become concerned because we have seen a high level of volatility in the market. How can I know for sure if she's in good hands and that there's nothing to worry about?
Well, thank you for the question. I mean, the simple thing is just get a second opinion. Have somebody else look at those investments and see what kind of risk, what time. Typically, there's probably cash flow that she needs from that portfolio. What kind of cash flow is being produced? What kind of risk is there for her? What kind of income does she need? Because again, we're going to solve for that first, right? Solve for the income needs first, and then let the portfolio be designed relative to the cash flow and the risk. So just get a second opinion. Have somebody else look at it that specializes in retirement income planning.
Last question from Julie in San Diego, and she writes, David, my husband and I recently retired and just moved to San Diego. We have our money with Edward Jones because we figured they have an office in just about everywhere. When we met with our new advisor here, we told him we want less risk and more income. Nothing has been done to meet our requests. Does your firm provide second opinions?
Well, Julia, thanks for the question and welcome to San Diego. Yeah, we do second opinions every day, right? And so absolutely, I hear that often, is that I tell my advisor I want less risk or I need more income, and they say, don't worry, you can take out this amount of money, but we don't have a written plan. Again, so yes, get a second opinion from a retirement income planning expert that's going to focus on risk mitigation and also income. So for sure, that's what I would do.
David, thanks so much. Hey, if you want more information about anything we spoke about here today, go ahead, pick up that phone, let's start a conversation, or go to our website. And don't go anywhere, we'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
San Diego, welcome back to the program. I'm here on AM 600, The Retirement Architect with David Reyes. He is a best-selling author, TV personality, and of course the host of this radio program. David, we have a great topic today, and that topic is, hey, this is what we all want. It's retirement income. Income is the outcome. And at Reyes Financial, this is extremely important to get it right so that when your clients are in retirement, they are well taken care of. So the first piece I want to talk about in here, and we kind of joke about it, but diversify income streams. And you say you look at portfolios once in a while that really the true term is diversify.
Yeah.
So take it from there.
Yeah, so I mean, income is the whole game. And when you go to retire, obviously we're trying to replace paychecks, right? Paychecks, playchecks, people call them. We want to have fun and get grandkids, trips, all the kind of things that people really do. When you do it as long as I have, you know what people really want. Grandkids is number one, right? Always, which is great. In fact, I had several clients in the last year move, 3 or 4, to be closer to grandkids, right? Move one Utah, I think one Arizona. But the fact is that it's important. And so it's really about the confidence. I always say, helping give people permission to spend their own money. And so we have to have the confidence in that cash flow, knowing that can be produced so they can have the lifestyle they have. People don't realize, what happens is we custody with Schwab, right? So we work with. So every month, our clients are getting a check that goes directly from their Schwab account to their bank account, just like their paycheck, ACH right in there. So it's kind of neat. It's no different than when they were working. Get a paycheck, goes directly deposited into their account, just like when they work now in retirement. That's what we're going to do, is create that same paycheck for them.
David, you've been around a long time, and I love this term that you use. We give the client permission to pay themselves.
Absolutely.
Right? Because this is very real. The mindset of the saver to the spender is something that I'm sure requires not just a singular conversation, but multiple conversations. But when you can look at someone and say, I'll just say, John and Mary, you're all set. You can spend this money.
Well, I got a funny story for you. So this just happened recently, a new client that's hiring us. So they have, a couple million, a couple $1 million, doesn't matter. But I think their expenditures, they have no mortgage, no nothing. I'm going off memory here. I think their net expenses are like $2,500 a month.
Oh my goodness.
Literally.
They've kept it lean and mean, huh?
And they will not spend their money, right?
Oh my goodness.
She wants to, he doesn't,
Yeah.
right? And of course their portfolio, that we love dividend paying stocks. So I showed them the portfolio I want to put them in, and also now we're producing about 5% cash flow for them with the strategy we're doing. And I'm like, look, you're not selling the assets, we're just creating the income. And so they were all excited, and now they're going to actually spend their money.
And if I've done my math correctly here, that's 10 grand? a month?
Yeah.
For over
well,
$2,500?
let's just say, on $2 million, it would be, it would be about $100,000 a year of cash flow to where, so $8,000 a month.
Yeah.
But that's money.
That's a lot better than $2,500, by the way.
Yeah, but they're not
How
selling.
happy must they be?
Yeah, but they're not selling their stocks. That's the key part. We're using some of our strategies. They're not selling their investments. They're living off the cash flow from the investments. And now mentally they can do that because now they're not losing. They're not saying, okay, now I sold some stock and now we've kind of transformed them. It was just funny to watch him smile because he was the one that didn't want to spend the money, the mister.
And that whole aspect of security, that's what it's all about. And when you come to Reyes, you're going to feel secure afterwards. And speaking of security, we need to talk about this. Can we rely on bonds today for the security piece in our portfolio?
Bonds are, again, I kind of, trash bonds a lot because we haven't used a lot of them, but they're getting more attractive every day as rates go higher, so that's one thing. But do they deserve a piece of your portfolio? Absolutely. The problem is they've been overutilized. Where do you think the 60-40 came from? 40%. So think of 40% of your portfolio that you thought was protecting you was going down in value. So I just think they've been overused. And again, because we're in the cash flow business, bonds have been unattractive from an income standpoint for 10 years, since the financial crisis. The rates, dropped through the floor. Went down to almost zero, right? So they've been a poor cash flow vehicle, and now they've become a very bad risk mitigator.
And my last piece of my puzzle here is some part of your portfolio to be in guaranteed income.
Yeah, so for some of our clients, and again, we use everything. So if it's appropriate for a client, it's something that they need from a risk perspective. We're looking. There's only a couple of investments that have guarantees. One is U.S. Treasury bonds, right? 2 is FDIC insured accounts, and 3 is life insurance and annuities. That's it. So if we can incorporate some guaranteed investments inside of there, especially with guaranteed lifetime income. And oh, by the way, talking about inflation, you can use inflation-protected, annuities that will allow you to have increased income over time, which we use in one of the books I wrote. We talked about that specifically about inflation-protected annuities. Is that they can be a very strong piece, especially the more risk-averse somebody is, the more we're going to look at vehicles like that. We have absolute protection, right? Again, disclosure-wise, it's always the claims paying ability of the insurance company, but we work with highly rated carriers and been around for a long time, and I've never had an issue with an annuity, thank God. So, but the fact is that they can be a cornerstone to some clients' portfolios.
I have to ask you this because the guaranteed source for it, and I'm not saying it correctly here, David, so forgive me. FDIC for the banks, right? But there is a separate entity for insurance companies, which really, at the end of the day, and the amount of money that needs to be on hand to insure insurance products is a lot higher than what the FDIC has. So as far as if you were to look at it apples to apples, it seems as though, for me, the layperson, that the greater guarantee might be with the insurance companies. Is that a fair statement?
Yeah, you can't say that though. So I would get in trouble. If I said that, I'd get in trouble.
You
can't.
I have to rescind that.
Because you're talking about the federal government. That's okay. You said it, not me. The federal government is behind the FDIC.
Yes.
The federal government is not behind XYZ insurance company. So it's the claims paying ability. Of the insurance company.
Yep.
Right. That's what the guarantee is based upon. So you have the claims paying ability of the federal government. Now you're right. The federal government's underinsured. The FDI insurance bucket is not 100% of what the assets are in there. That's kind of what you're probably getting at. But the fact is, you can't say, okay, it's safer than FDIC. No,
gotcha.
FDIC is going to be the safest because the federal government is behind that.
Love it. David, thank you for the clarity on that. Hey, listen, if you'd like David to put a second set of eyes on your portfolio, it's super easy. Just give him a call right now at 866-REYES-PLAN, and he will do a complimentary second opinion on your portfolio for you. Or you can go to the website, reyesplan.com. In San Diego, don't you go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Hi, and welcome to this week's Retirement True or False. David, I have some wonderful questions this week for Greater San Diego. My first question is, a written comprehensive retirement plan is the most important aspect of planning to provide you financial security. True or false?
True.
That is a big true, isn't it?
It's a big true.
Yeah.
Here's the sad part. I mean, one in 100 clients have a written plan. I mean, I may be being generous there too. So, all of our clients have a written retirement income plan. I mean, that's the call, begin with the end in mind, right? We have to start with what is we need to accomplish, and then you build portfolios backwards. Most advisory firms are saying, here's your pie chart, here's your stocks and bonds, a nice pretty pie chart. But the problem is that necessarily going to create the safest plan, the most cash flow to ensure we don't run out of money? So the difference is that we want to make sure we start with the planning first, and then we backfill that with the investments. Again, I look at investments like widgets. I don't care, again, green, purple, yellow. What is it going to do to create the most amount of income, least amount of risk, and ensure we don't run out of money?
Yeah, but David, there are people out there that have that pretty pie chart and the graphs that do this and that, and they're told, you take 4% out of this pile of money and you're good for the rest of your life. And that is their written plan, but that isn't a written plan because there are so many other aspects that have to go in there, right? And like you said, 1 out of 100 maybe that have come into your office. We've talked about this on other shows where here is a true retirement income plan that shows you this is how much money you will be able to spend of every month, of every year for the rest of your life, right? Oh, yeah. So few of those plans out there.
Yeah, it's just, unfortunately, it's a little bit kind of a laziness. I mean, I don't know how else to just, being honest, that's just, the reality is it takes work to do that. And a lot of firms are not willing to do that work. Absolutely.
Then that advisor needs to be accountable to the plan.
Absolutely.
And I don't think they're, but, I don't want to make a wide sweeping generalization, but I don't think a lot of advisors want to be accountable to a particular plan because they know potentially that their plan is based on something that's volatile.
Well, I'll share something with you. You're making me think of something. So I had a client just the other day that, and this is unusual, but in their statements, they had been the same advisor. It was a big bank. I won't name the bank. And they actually put a target, which is rare because it holds them accountable. What's the target return? Rarely ever see that. And it was basically like a 60-40 target return. And let's say the target return was 8% over the last 10 years or whatever. Their average return was less than 4%.
Wow. And
so it highlighted right there. So when I was reviewing the client's assets, I said, well, they're telling you right now they've underperformed by 100%, basically, right? Their target was 8, and you've gotten 4, and that's during a raging bull market.
Wow.
So that was you made me think about that. They were being accountable, but unfortunately they underperformed. And we're talking, I think they hired this firm in 2013. So 9 years they underperformed by 100%. Yep. Problem.
Right. Next question, David. I should not worry about stock market volatility and losses because the stock market will always recover. True or false?
Well, it's false. The fact is that whether it comes back or not is not the question. The question becomes, is it putting my retirement income at risk, right? Do I have the risk of running out of money? I use a statistic all the time. If you were retired in 2000 and you took out 5%, which was kind of the rule back, you could take 4 or 5% back then because the market was at peaks, right? We have to look at forward returns, not what's happened in the past, right? Is if you took out 5% plus I think a 3% inflation rate, you ran out of money in 2015. Because we had 50% corrections or bear markets. So it just depends. If you're accumulating assets, you can probably get away with that. But if you need the cash flow, especially when you need significant income, you're going to have problems.
And here's a big piece of it that we talk about on shows. And it's all where you get in and where you get out, right?
Right.
Not everyone gets in low and gets out high. Or I'll go one step further. When do you retire? Because you could retire at the beginning of a bull run. How wonderful, good for you. Or you could retire in the beginning of a big drop-off or bear market, where your portfolio takes a hit. Sequence of returns, I believe it's called, David, right?
Exactly.
Which is kind of complicated, but at the end of the day, it suggests that nobody has a crystal ball to know what's going to happen, but where you retire and what happens to the market could play a significant role in how much money you have to spend and enjoy in retirement, correct?
And we can't time that. We have a slide.
Nobody can time that.
Yeah, we have a slide we use in some presentations called the Hatfield and McCoys, right? And so you have two families, and so they both, let's say, get a 6% rate of return. One runs out of money in like 20 years, and one has like an extra 3 or 4 million, right? Because the fact is, when did you retire? Right? If you retired in 2000, you probably ran out of money. If you retired in 2009 at the bottom of a bear market, you have a lot more money. So that's just luck.
Yeah.
So we can't build our plans on luck, though. We have to be as precise as possible, right? Everything has some risk, but our job is to mitigate that risk as much as humanly possible, eliminate risk where we can, and so that's just the difference in, again, creating an income plan first that's going to be the driver to the investments.
Last question, David. Variable annuities are safe investments because they are annuities. They have no principal risk. True or false?
Very false. The key term is variable. So just think of it simple. If you have a variable, it can go up and down. A fixed annuity, right? If it has fixed in front of it, it means the principal is protected. Okay, it's guaranteed based upon the claims paying ability of the insurance company. So with that, you can if you're going to buy an annuity, typically you want to use an annuity that's going to have principal guarantees and/or lifetime income guarantees. So major differences. Variable annuities also have a lot more fees in general. I would say an average fee of a variable annuity is around 3%. I've seen them as high as 5%. You put that math together, right? $1 million annuity, you're talking $30,000, $50,000 a year in fees.
Goodness.
Yep. So that kills it. Plus, a lot of these things, let's say you have a guaranteed, this is a little bit kind of in the weeds, but let's say you have a guaranteed lifetime income benefit from a variable annuity. They're going to charge you that fee based upon what the guaranteed value is, not on what the account value is. So let's say your guaranteed value is $1 million, but your account value is $500,000. They're going to charge you the fee on a guaranteed value.
Goodness.
So it can double the fee that you're actually paying. So it can get pretty outrageous. We do a whole fee assessment specifically on mutual funds, but very, very much so also on variable annuities because it's pretty shocking in most cases.
David, thanks so much. If you want more information about anything we spoke about here today, or even one better, David, get David's eyes to look at your plan, a complimentary second opinion. Call 866-REYES-PLAN or go to our website, reyesplan.com. Don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866-REYES-PLAN for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Today I want to talk about worrying about your money, or stop worrying about your money. Probably the most fulfilling thing for myself, selfishly, is that if I can get a client to go from being concerned about their retirement income to not being concerned and watching them physically relax, I watch people's smile go back on their face after we do some planning, that would be number one, right? We don't want it to be this picture, and there's no reason for it. And I'll tell you the number one way to do that is have a written plan. Have a written retirement income plan, because people worrying like this, and maybe you, is because you're not sure how much you can spend, right? Or you're not sure if you're going to run out of money, right? And so those types of issues everybody has, because it's a lot easier to save money than it is to spend money. Because every time we take a dollar out of our piggy bank, so to speak, we think we have less money, right? What if there's a better way? What if we could create plans where we just create cash flow from our investments? Think of real estate as an asset class, right? What's great about real estate, we own the asset, we have a rental property, we get the income. Am I selling the third bedroom, right? As I like to say on my radio show, that's not cash flow. That's selling an asset. On our firm, what we want to do is create cash flow streams so we can maintain the integrity of our portfolio and not only have more income, but more assets and hopefully more money to pass on to our kids. So we want to get away from this, right? Not having to deal with that. Part of that is having the right advisor. Now, you may be your own advisor, do it yourself, or I call it the Home Depot advisor, right? You got your degree at Home Depot. And the nice part about that, you've probably done a good job, right? Most of my clients, maybe like you, have already kind of won. You have all the money you're going to have. Now what we want to do is optimize that. Make sure that we don't take on too much risk, that we have the cash flow that we need. What about inflation? What about taxes? So we're going to put all that stuff in writing, a written plan. And so the fact that we have that plan, that roadmap, is going to allow us to not be worried about our money. So then what we do is after we know what's possible, right, then we can design our life around that. But bottom line, we're trying to just replace the income that you currently have. We don't want to reduce income. I'll tell you, most people spend as much or more money in retirement than they did while they were working. So there's no, we only need 50% or 70% of our income in retirement. No. What about kids, grandkids, travel? So again, doing this for a long time, 27 years, focusing on retirement income planning, we don't want to have clients that are like this, right? So we can hopefully turn that kind of frown into a smile and make sure that you're happy with the plan that you have. So if you want to reach out to us and get a complimentary second opinion, please do give us a call or go to our website.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. This is a $999 value that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have, by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go, and who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, hey, pick up the phone and give us a call in the office at 866-REYES-PLAN or visit our website.
And remember, you retire once, we retire every day.